Christine Ferguson-Rau. Thank you so much for coming.
Sure.
She is the senior financial executive with extensive leadership experience and proven record of implementing strategies to drive revenue growth, increase profitability, and achieve corporate objectives. She has a passion for helping entrepreneurs grow their businesses, profitability, and button up to increase corporate valuation. Christine has deep experience with privately held companies and nonprofits, from early stage startups to organizations with up to 250 million in revenue. Christine has successfully raised funds in private financings, completed over 50 million in M&A transactions, and negotiated over 50 million in debt and instruments for companies. So I'll let you get started.
Sure. I'm an alum too.
Yeah.
So it's nice to meet everybody. Thanks for joining on this snowy day, especially the folks that are here. How exciting. So I'm going to talk with great enthusiasm about the boring parts of startups. I know that this is not the part of startups that anybody thinks about that much when they get going. This is the part that is not exciting, that it's hard to get like really excited about, but it's essential. So let's just move on. I should be using this. Sorry, I did the arrow. And, oh, okay. Great, thank you. Okay. Okay, so starting a business. So the resources that are required, of course, we're going to make a product or deliver a service. So we need labor, materials, energy of different sorts, human being energy and other energy, property, plant, and equipment, perhaps, even something as mundane as computers, of course. And everybody needs money. And another term for money in this realm is capital. So sources of capital for a startup, depending on where you are in the continuum of growth, you begin with what's euphemistically called friends and family. In other words, anybody that knows you and trusts you enough to give them their personal capital. Angel investors, people who are qualified investors, as it is defined by the IRS and by the SEC, to invest their personal assets into early stage companies that are very high risk, venture capitalists who invest in companies that are further along in the continuum of growth. Crowdfunding is a new way to fund an early stage startup, but eventually everybody has to get into the debt markets, and who offers debt are banks and other financial institutions. So becoming fit to obtain capital means that you're ready to get equity capital and debt. And the way that you get them both is very, very similar. So how do we obtain capital? And feel free, anybody, ask questions anytime. You don't have to wait till the end. Okay. And I hope everyone can hear me with my mask on. So let me know if you're having any difficulty. Okay, so if you want to obtain financing, capital, which everybody needs to, you have to have some basic documents. You need a business plan, and a business plan is a defined term. It's not just something you make up. It's a defined document with a format. You can find those formats online. I am sure the Tepper School of Business and the Short Center offer templates for them. They probably offer samples of excellent business plans as well, but a business plan lays out your idea, how you plan to provide the service or product, who you provide it to, what the business model is, what the revenue model is, how you're going to market your product and to whom. It's the first important document of any business. Okay, then you need to demonstrate the viability of the business through financial statements. Now, if this is an existing business that's trying to obtain capital, new capital, then you can do a look back of 2 years of financial statements. If it's an early stage company, those financial statements are forward looking, and the term that's used for them is pro forma financial statements. And then a demonstration of the cash flow potential of the business, which again is pro forma going forward for 3 years. If it's a startup, those are based on projections, things you think are going to happen. If it's an existing business, they have to be tied to past performance. Okay. So in order to obtain capital, it's important to speak the languages of business. There are 3 main languages of business: accounting, finance, and economics. 3 of my favorite things. And I hope they're yours. So I'm asked often, what's the difference between accounting and finance? And it's very simple on a very high level. Accounting looks backwards. It tells you what happened yesterday, last month, last week, last year, a period of time that's passed. It provides a way to track your overall financial position, your revenues, your expenses, your capital investment, and many other things. But again, it looks backwards. And accounting is rule-based because accounting provides the platform by which our nation and any nation collects taxes, compares the performance of different entities. So it has to be rules-based. We have to all play by the same rules or you can't compare. You're comparing apples to oranges instead of apples to apples, and we have to be able to do that. So it's a rule-based system governed, in our case, by generally accepted accounting principles and blessed by the IRS, the SEC. And it provides companies with a way to track their performance and communicate their results in a standardized way to interested parties outside of the entity. Venture capitalists, angel investors, friends and family, banks, financial institutions, they all need this information, which makes it really important to get it right. I've been working with early stage companies. I've founded 3 companies myself, and I have to tell you that, and I just, my colleague Donald Bonk and I both led a cohort of 17 companies last semester of all existing companies in a project to help them scale. And we polled the companies early in our venture and said, what do you consider the biggest challenge to scaling your business? And number 1 by far was finance. So I feel like it's never too early or often to address this issue with early stage companies. Okay, finance, distinct from accounting. Finance looks forward, and therefore it is critical to the decision-making processes at different companies. So finance analyzes the accounting numbers. Finance looks at what accounting has said has happened, but finance looks forward to create projections of what may happen in the future, but again, tied to the past. If it's a startup, you can tie your pro forma to what has happened in other companies, what has happened in an industry. But these are not, we don't just float numbers out there out of our imagination. We tie them to some basis. Okay. So when you think of the language of finance, think of assessing value, looking into the future, calculating rates of return on invested capital. You have to invest capital to produce the results that you're modeling in your pro forma, and then allocating capital. So we could be looking at a pro forma that says, I have 3 revenue streams, and I've got a different margin on each revenue stream. So the one that has the biggest margin is the one I'm going to allocate most of my capital to. When you do that, an investor is going to sit up and take notice because that's a logical way to proceed. Okay. Any questions? Feel free. Okay, economics is the 3rd language of business. Economics looks externally outside of the company and looks at the way markets behave, the impact of government regulation on the entity, and individual preferences. So who am I selling to? What do they like and don't like? That matters as well. And economics paints us a picture of how our target markets behave. And it provides us with an understanding at a high level of supply and demand for our products or service, consumer preferences, price sensitivity, all really important things to consider in your business plan, in your pro formas. If you don't pay attention to economics, you will get in trouble when you pitch. You'll get called on it. So don't forget that piece of your analysis. Okay, so now we're going to get into the detail of what we're trying to do. Again, this is internal accounting for startups. So companies, all companies produce 3 financial statements. Now in a startup world, these could be pro forma financial statements. They're not going to be based on real results because you don't have any yet. But you are going to have to project what you think you can do. And you still provide that information through these financial statements. Balance sheet, which identifies the assets and liabilities of the company, the invested capital, and the source of the invested capital. The income statement, which shows revenues and expenses, gross and net margins, how much you're going to make from doing this. And the cash flow statement, which takes the 2 financial statements, the balance sheet and the income statement, ties them together and takes away all of the non-cash impacts of the business's performance. Things like depreciation, amortization. Okay. All right. So the balance sheet displays the company's total assets and how those assets are financed, either debt or equity. The balance sheet is based on the fundamental equation that assets equal liabilities plus owner's equity. Equity is just another term for the ownership capital invested in the company. So the ownership of the company can be, for an early stage company, that's going to be entirely cash in. But for a company that's been in business a long time, that can also reflect a change in corporate valuation. Okay. So here we go. This is the way a balance sheet is structured. So you have the assets, current and non-current. The difference between current and non-current is just the amount of time they spend on the balance sheet. Current assets are going to be used within 12 months. So things like cash, accounts receivable, hopefully inventory, because you're never going to keep more than 12 months of inventory, hopefully. You never want to. I'm not going to say companies don't, because I would be telling an untruth. But well-run companies are not going to hold a bunch of inventory unless the lead time to produce their inventory is longer than 12 months, which rarely is anymore. Used to be years ago. Non-current assets are those that are going to be used for longer than a year. So property, plant, and equipment that is purchased, even a computer that's going to be used for 3 years would be a non-current asset. If you use them, maybe they have to be replaced every 18 months, but it's still longer than 12 months. For a company that produces, that's a manufacturing company that has a product that you hold in your hand that is produced, there's going to be property, plant, and equipment to produce that product. That's going to be in your non-current assets. And then you have liabilities. Current liabilities, things like accounts payable, things your people you owe, and they're going to expect to be paid in less than a year. Non-current liabilities could be financing for non-current assets. So it's really important when you're running a company, you want to finance current assets with current liabilities, finance non-current assets with non-current liabilities. The term and tenor of a financing should match the term and tenor of an asset. And I know I'm using language that is very familiar to me. If it's not familiar to anybody else, please raise your hand. Happy to explain. Yeah.
By curiosity, would non-current liabilities be any long-term debt that you have as a company? So bonds or what have you, right?
Companies typically, especially startups, don't have bonds. Bonds are for much bigger companies, but you could have convertible debt. You could have right? That's very, convertible notes are very, a vehicle to bring in equity capital for early stage companies used all the time. So as long as it hasn't converted, that's debt. Right? So yes, that's a really good question. But for larger established companies, if you're going to say buy property, plant, and equipment, you're not going to use accounts receivable or cash to do that. That would be silly. You would be risking the funding of your cash cycle to do that. Instead, you would finance property, plant, and equipment with debt that matches the term of the asset. You're going to use the asset for 5 years. You finance it with a 5-year term loan, and that would be a non-current liability. Correct. Mhm. Anybody out there in virtual world have a question? Okay. So this is a sample balance sheet. It's quite simple, but I just want to make sure that everybody views these financial statements and becomes familiar with them. The more you become familiar, the better off you will be in any business venture. These don't need to be a mystery. They're really quite, I think they're quite easy to interpret, but I know my position on that is not shared by everybody. I have encountered many folks that start companies that are not familiar with these financial statements, which is why I'm here today. I know there's a need for this knowledge that doesn't exist. So this is what a balance sheet looks like. Is there a pointer around, or that's okay, that's fine. So assets, current, we have cash. We don't have to talk about that. Okay. Temporary investments, somebody that's lent us money. This could be a line of credit that's going to be, it only has a 1-year duration. There's our accounts receivable, our inventory, which is a current asset considered it's going to turn in less than a year. Some supplies are going to be used in less than a year. Prepaid insurance, it's just a prepayment that we made for insurance we're going to use in the next 12 months. And then we have some short-term investments. This could be money market. We own land. We've improved the land. We have buildings, equipment. We've got accumulated depreciation. This is property, plant, and equipment. So this is probably a balance sheet for a manufacturer of something. They wouldn't have all those things if they weren't. Okay, then we have intangible assets. So we know that this company exists because an intangible asset, goodwill, is the difference in the corporate valuation minus the actual assets. Okay, so let's say that a company is going to acquire another company. A company is going to acquire another company for $1 million. But the value of the actual assets on the balance sheet is $750,000. The other $250,000 of the acquisition price has to be put somewhere on the new entity's balance sheet. It goes into goodwill. Yes.
Just repeat, goodwill is the perceived value minus which assets are.
Correct. So again, not the perceived value, the value as established by the acquisition price.
Okay.
Somebody is willing to buy that company for $1 million, but the assets that they're getting are worth, because asset values are clear, are worth $750,000, which means that there is this other thing, this intangible asset called goodwill, that is a placeholder for the $250,000 of value that is perceived by the market in an arm's length transaction. Somebody wants to buy it. It's sort of like a car, right? So cars right now are inflated. So a car that might 2 years ago have been worth $3,000 is now worth $6,000. Now the car itself is probably worth $2,000. The value of the car, if you melted down the metal, or if you recycled the tires or whatever, it could be, maybe it's worth $1 or $2, but somebody's willing to pay $6,000 for it. The difference between the 3 and the 6 would be goodwill. if we were to put that on a balance sheet.
Okay, makes sense.
Okay,
Thank you.
okay. Trade names, brands have value. Brands have a great deal of value, especially today. And they are given a value based on a number of things, but that's what's being held here. This is a value of a brand. So in this case, this company has current assets of 89,000, short-term investments of 36,000. They have total actual tangible assets of 337,000. Then they have almost as much as an intangible. So that tells you that this is an existing business that's been around a long time. You can't develop a brand or establish that much intangible asset without existing for a while. And then we have, so we have our total assets, which adds these two numbers. And then that number, as you can see, the total asset number, I hope everybody can see this, it's online, matches exactly liabilities plus owner's equity. So the liabilities we can establish, we know what they are, right? We've got notes payable. That's a line of credit. We owe somebody $5,000 on a line of credit. It's got to be paid within a year. That's why it's here. Accounts payable. We owe people, that's our electric bill and our utility bills and our health insurance and everything else. We owe our people, wages payable. We have interest on debt that we have. Taxes that have to be paid quarterly. We have a perceived warranty liability. So we have product in the market that has a warranty and we have to value the potential liability for that. And again, that warranty is probably a year or less, which is why it's showing up in current liabilities. And then revenue that we've received, but we haven't done what we're doing with it yet. So someone's paid us to provide them products we haven't shipped yet, or a service we haven't provided yet. That's what goes here. So current liabilities, pretty clear. We know what they are. Long-term liabilities, we've got a long-term note payable, which means this is a term loan. And in this case, they do have bond financing. That's quite long. Bonds can be 30 years. So we've got liabilities here. Total liabilities 481. You take this 770, you subtract the 481, and you get this. So we know that initial capital 110. This was when the company was started. That's what was placed in the company to establish it originally. We have down here, we have, so we have retained earnings, which comes from the income statement. It's the amount of money, the difference between our revenues and our expenses. We've got treasury stock. So we have used our cash to repurchase our own shares, which had already been on the market. Those are treasury, that's treasury stock. And a little bit of other income, which can be a number of things you want to go into. But we end up with, every time when a balance sheet is accurate, this number and this number have to be the same. Okay? Yes.
Quick question. The trade name valuation, what's the formula?
So that that's a good question. So a trade name, it's a brand. That number is open to interpretation,
Okay.
but it's open to interpretation provided there has not been an acquisition. If there's a transaction of some kind, if the company has been transacted, if it has merged or been acquired or changed hands, or even been assigned into a, let's say it's privately held and it's going into a trust for legal purposes, any kind of event requires a formal valuation. And there are ways and people who spend their days valuing intangible assets, and you can pay for that kind of valuation. But that's if you need a valuation, say for a transaction. At the end of the day, the transaction defines the value. So if somebody's willing to pay you $1 million for your brand, it's worth $1 million. It's like your house. Your house, you could have built it for 100,000, but if someone's willing to pay you 8, it's worth 8. Yes.
So by extension, the trade value can become a loose number depending on what the company thinks its value is.
I wouldn't go that far.
Okay.
You don't pull a number out of the air.
Exactly.
You don't.
Yeah.
No, there has to be some basis in reality. And that basis can be the brands of other companies that have transacted, if yours has not. It can be, again, assigned value based on you own the company, your assets are $500,000, somebody offers you $1 million and you take it, you have now assigned a value to your intangibles. So it's always rooted in something. It's not plucked out of the air.
You need something to back it up.
You bet.
Okay, makes sense. Thank you.
Okay. Okay, an income statement in contrast to the balance sheet, this shows revenues, expenses, and profit or loss. And as you can see with my choice of color, this is a profitable company because the bottom line is green. If it were not a profitable company, the bottom line would be red. And we don't have those here at CMU, so we're not going to talk about those. Okay. So this is a sample of a very simple income statement. Revenues, cost of goods sold. These are expenses incurred directly to produce the product or service that we're selling. In other words, if we don't spend this money, we can't get this revenue. So things like programmers that are coding the actual application we're selling, that's in here. The people who work in the co-packer that's making the product we're selling, that's in here. Okay, then from the gross profit. Okay, now here's something very important to remember when you're learning the language of business. Gross profit is a number, gross margin is a percentage. Okay, so gross profit is a number, gross margin is a percentage. Gross profit is 800,000, gross margin is 80%, this divided by this. Which is, by the way, a hell of a gross margin. Okay, then we have operating expenses. These are, so you'll hear a term G&A, which stands for general and administrative. The older fashioned term is SG&A, sales, general and administrative expenses. These are expenses a company incurs to do what it does, but they are not directly related to what is produced. You have to have sales, you have to have marketing, you have to have accounting, but whether you do or don't has no bearing on whether or not you produce your product or service. So, and there's also this other term you'll hear. There's a lot of language around this. Above the line and below the line. These expenses are above the line. These are below the line. Okay, so we get a gross profit and a gross margin, which again is gross profit divided by revenue. And we get a net income and a net margin, which is net income divided by revenue. So both are very important numbers, and they're going to take those numbers and compare them to other companies. So you have to be mindful of it. So if I have a technology startup and I'm producing software to do a certain thing, there's other companies that are already doing that. I want to pay attention to what are their gross margins and what are their net margins. How do mine compare? There's standards for these things. Helps you know where you stand before you pitch. Okay. All right. The cash flow statement is then the financial statement that ties these two statements, the balance sheet and the income statement, together. So this statement shows the cash flow. So at the end of the day, what do we do? We're starting a company to produce cash. High level, that's what we're doing. If we have a company that does not produce cash, we won't have a company for very long. So this statement says, where does the cash we're producing come from? Operating capital, operating cash comes from the sale of goods or services. Investing is capital that is sourced from a buying or selling of an asset, which could be a building, it could be property, plant, and equipment, it could be something, but it is not from the operation of the company. It's something from another source. And then financing is money coming from outside the company. So you're either getting debt or equity. That's coming from financial institutions. It also can come from private capital markets. If you want to have a direct loan from a corporation. And again, equity, right? Coming from friends and family, from angel investors, from venture capitalists, from an IPO, or from a bond financing. But it's coming from outside the company. The company is producing. This is the most important one for an established company. This is the most important one for a startup. Startup doesn't really have anything to do here yet. Except what happens here as well is the change in current assets. So increase or decrease in accounts receivable and accounts payable shows up here. If we have a whole bunch of, we have $40,000 in accounts receivable at the beginning of a time period, and we have 20 at the end, we've produced 20,000 in cash by collecting on those receivables. That goes here. Okay. All right. Okay, this is what a cash flow statement looks like. Again, those three things that I had before, the three tranches, sort of the three levels. Cash from operations here. Net income first. That's what showed up on our income statement. We add back depreciation because depreciation is a non-cash expense. It reduces taxable income, but it is not a cash thing. So it's just masking income. So we added that. We increased inventory. We spent money for inventory. So we have to reduce cash by that. We got cash from reducing our receivables. And the total of those numbers is our net cash from operations. Cash flow from investing. We sold property and equipment and got money for it. We bought, so maybe we sold equipment that was old, we bought equipment that was new, so a net cash change is to reduce cash, net cash out. We reduced debt for financing, and so here we go. We just total the three lines. This number plus this number gets you that number. So we worked for a year. And essentially, at the end of the year, after we did everything we were doing, we produced cash. So that's a successful year. The bigger that number, the better you're doing. Okay. So now I've shown you the financial statements. However, they're only as good as the data behind them. So building accurate financial statements is essential to understanding your company's performance and being able to convey that performance with authority to anyone that can provide you capital. So everybody that is looking at you as a potential investment is going to know if you know your numbers or you don't. It is one of the ways that investors evaluate companies. Does the CEO know their numbers? It's used. When investors look at companies, they're looking at, say, 5 companies pitch on the same day. Who knows their numbers best? That startup is going to get more money. Very important. So it's not just knowing the numbers, it's knowing that the numbers are right or that you can defend them. You've come up with numbers that have a good basis for being there in a pro forma. All right, so how do we build financial statements that will impress an investor? So now we're going to get a little bit into the nitty-gritty, which again, I find fascinating. You don't have to share my enthusiasm, but it is really important to know this stuff. Every company has a ledger, also referred to as a general ledger, with the acronym GL. You'll hear that a lot. It's a good idea to know what people are talking about. Back in the 1800s and even the 1950s, ledgers were paper-based. People took a pen and paper and they made entries. Today, they're all electronic. And the most ubiquitous platform for startups and small businesses is something called Quickbooks. If you're not familiar, it's easy to become familiar on YouTube. It's not really that expensive, but it's essential to have a tool that allows you to track your expenses and your revenues and your capital. It's really essential. It's the industry standard for small existing businesses. And because it's the industry standard, you will find that most banks, when you go to have a company, of course, you have to have a bank account for the company. You have to have an employer identification number to get a business checking account, also known as an operating account. When you have that and you have your EIN, you need a way to produce financial statements for that EIN. QuickBooks is a way to do that. One of the ways that you can, because QuickBooks is, again, the most ubiquitous platform, banks have an automatic download feature that takes financial data and plugs it right into QuickBooks, right into the general ledger without human intervention. And it's pretty much the only software you'll find when you go to banks. If you go to the online banking feature of banks and you say, download my transaction data from my account into a platform, they're going to give you the QuickBooks option almost every time. I don't know any bank that doesn't. Okay. Makes your work a lot better. You don't have to key in anything into a software package. So who do we have here? Do we have people that are thinking of starting companies, people that already have? I'm curious as to what people are using to track their revenue and expenses now. Anybody out there already have a company? No responses. Don't know. Okay.
Curiosity.
Mhm.
I know in the early startup, money is a big factor. Would you start with maybe basic Excel for accounting? If it's very like a simple transactions, and then maybe evolve to QuickBooks. QuickBooks can be a little bit more expensive for Excel. And if you have a cost conscious startup, you would start from the basic Excel and move forward as you grow.
So that's, I'm glad you asked that, because that's of course what most people folks do. The problem is when you start with Excel, you're starting with a blank spreadsheet. And you have to create the general ledger and the financial statements and everything. With QuickBooks, you don't. It's all set up for you. You press a button, you get an income statement. You press a button, you get a balance sheet. You press a button, you get a cash flow. That is not to be taken lightly. QuickBooks also tells you when your things don't add up. So if your balance sheet doesn't balance, it sends up a red flag and says your balance sheet doesn't, Excel doesn't do any of that. So an annual copy of desktop version of QuickBooks is about $400. I know that seems like if you're starting with nothing, that's not nothing, but in the scheme of things, it's a small expense. Educational institutions often get discounts. So there may be ways through the Schwartz Center to get one of those discounts. The QuickBooks Online, which a lot of folks like to use, it's more like $80 a month. So it's quite a bit more expensive. But if cash flow is an issue and you just want to spend a little bit a month, or if you have a founder that's in Pittsburgh and another member of the board that's in another place, so you want to be able to access everything in the cloud, you know, that may be an option. At this point, the two products are not equivalent. The functionality of desktop is worlds ahead of the functionality of the online version, the cloud version. So at this time, I'm advocating for the desktop version, but I'm sure as Intuit goes forward, they're going to move functionality into the cloud, and that's going to become more robust, but it is not today. So, and it's also the case that when you use Excel, you have to type everything in, or you could download a CSV file and do that. But again, you're going to have to create that framework, and that is not a small thing.
I imagine it'd be a lot of work, starting from a blank spreadsheet.
Not just a lot of work, a lot of knowledge to do the work. And you'd almost have to be a CPA to do it correctly. So anyway, is it possible? Of course. Is it recommended? No. But every startup does what they have to do to be scrappy. Also, one version of QuickBooks, like if you buy QuickBooks Desktop, you can start multiple companies in that software, not just one. You don't have to buy one license per company. You can have 10 companies, one license. So it's possible to share. Okay, so the foundation of an accounting system. So the general ledger is where all the transactions are housed. How that general ledger is organized to create financial statements is through a tool called a chart of accounts, COA. You'll hear about that, chart of accounts. It's the foundation of a company's financial system, just like the foundation is the basis for a building. You build on it. So it's very important. And it's something that a lot of companies don't pay attention to. I get QuickBooks or I get an accounting system. It comes with a built-in chart of accounts. I download it, I use it. No, not a good idea. It's a basis. It's not necessarily what you need. Just like if you took, let's say you have one share of 10 publicly traded companies. Owning one share of a company entitles you to get their annual report. In their annual report, they provide their financial statement. Let's say you send an email to the head of investor relations for each one of those companies that you own one share of. And you say, send me your annual report. They have to do that by law. Okay, so you get these 10 sets of annual reports. Now you have 10 balance sheets, 10 income statements, 10 statements of cash flow. If you lay them all on a counter, right here, they are not going to be the same. Every balance sheet is going to have some accounts that are the same, some that are different. Every income statement is going to be remarkably different. Foundationally, they're going to have these sections: current assets, non-current assets, equity, expense, revenues, expenses. They're going to have those categories, but within those categories, they're going to have a lot of difference. That difference comes from changes in the chart of accounts. The chart of accounts should match the kind of company you have. So if you have, let's say you have a service business and you offer 3 different services. In your chart of accounts, each one of those services should have its own line. I'm getting this much money from sales of my app. I'm getting this much money from renewals of existing apps. I'm getting this much money from the sale of products that align with my app. So tangible items. Maybe I have an app that has a character in it, and then I have a tangible version of that character that I'm selling. I want to have in my chart of accounts 3 different accounts for those revenue streams, because I want to tie the cost of producing that revenue to each stream, and I want to calculate a margin, a gross margin on every revenue stream. Very important. That's the only way to know if I'm correctly allocating capital to those endeavors. Since I'm getting a lot of silence online, I'm hoping people are getting something out of this. Okay. So you own your chart of accounts. You design it. It's sort of like a house. You decide when you're building a house, which room is going to be the dining room, which one's going to be the living room, how big are they going to be? It's all up to you. You have a basic framework. A house has to have walls and a roof and a foundation. Same thing with a chart of accounts. After that, you get to decorate yourself. You have a lot of license to create it. The way you do that says a lot about your understanding of finance and accounting. So again, when you organize your chart of accounts, you want to think forward. Who is going to be looking at my financial statements? Investors? What will they want to see? How do I organize my chart of accounts in a way that I can provide that to them? So for a startup, you want your chart of accounts to demonstrate to potential investors that you have a business model that produces significant revenue. You can do that while making cash, producing cash, making money. And that as you go forward, as they invest in you, you're going to produce more and more cash over time. If you're, let's say you are an existing company and you're going to be using those financial statements to share with someone who's considering acquiring you, they're going to be a little bit different. Again, using the annual report example, financial statements are used to convey to the people that own you, to the investors, the shareholders, how'd you do last year? How'd you do 2 years ago? That's what they're used for, to provide clear insight into the financial health of a company. So depending on where you are, if you're a startup, you're creating these financial statements to prove to investors that you're a better investment than an alternative. So it's very important to be mindful of that when you construct your chart of accounts. It's a good area to get some advice. There's lots of advice at CMU to be had on how to do these. Okay, so this is a very basic look at how to organize a chart of accounts. This is kind of a chart of accounts has numbers assigned to actual general ledger accounts. And these are the ranges that are typically recommended. Assets start with a 1, liabilities start with a 2, equity starts with a 3, revenue of 4, cost of goods sold of 5, and so on. It's sort of what you'll see if you, again, compare the charts of accounts to many companies, they'll be organized that way. And there are companies that have 900s and 1,000. There are other things that you might want to have, but this is a really good guide. And I know that everybody can have this presentation later, so there's no need to write any of this down, but okay. So this is what a chart of accounts looks like in reality. This is, again, very simple, but it's one that this is what one looks like. So this is for a balance sheet. Again, if you have a company, you have money flowing through it, even if it's equity capital and you're just spending it, you need a way to keep track. You keep track using a bank account, known as an operating account. It's a checking account because money flows in and out of it. So it's listed on your chart of accounts on its own line. Then you have your accounts receivable. Somebody owes you money for what you're doing. Hopefully you've sold something. Maybe you haven't. Maybe you don't have any receivables because you haven't sold anything yet. That's okay. You still have a place for it in your chart because someday you will sell something. Inventory, you may or may not have any inventory. Anybody that's, say, a technology company that's selling a service. Right now, I'm chief financial officer for a company that is in cybersecurity. They have no inventory. There's nothing, right? It's a service provided online, and it's created by people that are coding. But if you have a company that sells a product or service, if you have a consumer packaged goods company, if you have a manufacturing company, you're going to have inventory. So that's where that goes. It's always a good idea to have that in your chart, even if you're not using it. If you have an account in a chart and it has nothing in it, when you create a financial statement, it will not appear. Okay? So you can have it and not use it.
So if something like $0 just wouldn't exist per se.
It exists in the chart, but when a financial statement is created from a chart, again, it doesn't show up because the only things that show up on a financial statement are things that have numbers in them. Okay? Yeah. So I just recommend having it because you never know. Someday you could buy something that you need to hold in inventory, and then you have a way to do it without recreating your chart. Okay. Computer equipment, fixed assets, depreciation on those, again, a non-cash expense, but a place where you accumulate depreciation to show how old your assets are. If your assets, if you have fixed assets worth 10,000 and accumulated depreciation is 9,500, it's time to buy a new computer, and everybody knows that. If you have $10,000 in computer equipment and depreciation is 1,000, then you know they're in the initial part of their useful life. So this stuff tells people outside the organization things. Accounts payable, you've sold something, somebody needs to pay you for it. This is going to rise and fall with your terms. if you expect payment immediately, or even if you take payment, my first company, I had a revenue model where a company signed a contract, they paid 50% upon signing of the contract, and the other 50% on the day of execution. So there weren't a lot of receivables. Payables were simply always going to be considerably lower than the receivables. Good revenue model. Current liability, wages payable to people that are doing the work. Taxes payable, there's going to be payroll taxes and then income taxes. That's why these are separate. A loan if there is one. Equity always, because somebody's capitalizing this thing. Retained earnings if you've created cash from your income statement. Yeah.
So question, the build out of this chart of accounts that we have.
Uh-huh.
You know, bank asset, checking account at the top, equity at the bottom. Is that a fixed standard way of breaking out the pieces, or can other people do it separate, different?
Great question. So it is a standard and it is flexible.
Okay.
However, these are things every company needs.
No, I understood that. I just meant the organization.
Yes, absolutely. So some companies will have 4 bank accounts for different reasons, and
Right.
they're going to have 4 lines.
But you want to start with the checking account or a cash flow account at the top.
Got to have a place to make the money flow in and out of,
Right,
where you
right.
create official records that will be recognized by the
Yeah,
IRS.
so that's number one. Number two, number three. Second question on the codes. It starts at 101, ends at 330. What is the logic behind the coding? Is any rhyme or
This-
reason? Okay,
It's just, again,
it's just a custom.
and actually, there are companies that start with 10,000 because they want to have a bunch of
Right,
other
because I've
ways.
seen others different, and I just wondered if there was this is the general one that people can break out. Okay.
They
I've seen
do,
both ways.
but typically assets start with a 1. It could be 100, 1,000, 10,000, whatever, but it's a 1 in front.
Got it.
Yeah.
Because I've seen some different, that's why I was questioning.
Yep.
Okay.
Okay, so this is the balance sheet. This is the income statement. And this is going to get, typically this can, okay. So it's really an interesting thing when you're creating a chart of accounts for an income statement, because you have to think in terms of who's it going to be, who is going to look at it? What's the reason for the construction? So if we're going to share it, say, with investors, and we're a large CO company and we have, wow, 10,000 shares outstanding. So it's going to go out to a whole bunch of people. This is going to be super collapsed and simple. Revenue, expenses, gross margin, G&A, net margin. Simple. Doesn't mean the chart is simple, means that they're only choosing to show certain accounts and publish. The chart, because I'm a CFO for lots of companies, so when I go into a company, I often offer the chart, especially if it's an early stage company that really opened up QuickBooks and used what was there. And then they find out that investors are asking questions they can't answer because their chart's not clear. So they'll hire me to come in and revise it. Not the only thing I do for them, but one of the things I do for them. So I'm actually CFO right now for a company that's gotten a merger offer. And the company that is thinking of merging has offered their financial statements, and we have ours, and the format's different. So in order to be able to compare the two, there needs to be adjustments, which we knew. So you're always going to have revenue, but again, this revenue line can be, if it's a startup, it can be, and you have one product and you're selling it to, one thing or one service, it can be one line. If you have various revenue streams, you have to have a line for each one. When you share your financial statement with an outside entity, you can collapse them into one line. But you, as the founder, need to know the source of the revenue. Where's your money coming from? If you don't, if it's all going into one bucket, you don't know what to invest more in. I got 3 products. And I have all my sales in one line. Somebody says to you, which product is most profitable? You don't know. Super important to know. Okay, cost of goods sold, again, it's one bucket. But 3 revenue streams, we want to identify the cost of each revenue stream. We want to allocate those expenses to the line. There's lots of ways to do that. That's the 102 course. But just for 101, understand that it's a good idea. Okay, so again, direct cost. You can't produce your product or service without spending this money. Then we get into the general and administrative, advertising, consulting and accounting, postage, insurance, liability insurance, just you have the cost of doing business. Attorneys to set up, do your corporate formation, to set up your contracts, to review things. Utilities to keep, the computers running, right? If you have a founder that has a corporate automobile, if you have salespeople that actually visit people physically, they could have corporate cars. Office expenses, ink for the printers, new drives for the computers, whatever. Rent if you have an office. Salaries and wages for the people that work there. Then payroll taxes by law. Dues and subscriptions, this is a big one. So let's say you have a tech stack that involves a whole bunch of SaaS models. They go here. Those are dues and subscriptions, even though they're software. Okay. This is your internet expense. Again, travel, if anybody does that. Depreciation, non-cash, again, simple. Interest is at the bottom. Interest if you have debt, capital. Okay. So all a financial statement does is it takes the information that's in the chart that you have placed there using the organization that you've established in your chart, and it displays that information in a standard way, according to generally accepted accounting principles, and into those 3 financial statements that are so essential: balance sheet, income statement, cash flow. So knowing how they're constructed and being mindful about how you do that and purposeful allows you to really understand your company, your financial situation, and to be able to explain it. Anybody that knows all that knows their numbers and is going to impress investors. And that's enough for one day. So I'm more than happy to take questions. That's me, in case anyone wants to ask a question later. You're welcome to do so.
Do you guys have any questions?
Very good presentation, thank you.
Thank
I
you.
think it's, this helped my entrepreneurship class and also my business management class, kind of more about accounting, how cash flow works. So I do appreciate the presentation today.
Good, very good. I'm glad. I'm very glad you came. Thank you.
All right, well, if we don't have any questions, I'll end the meeting for all online. And it'll be up on YouTube, and thank you so much for
You're
coming.
welcome.